Hi everyone, thank you for joining me this evening. I'm James, market strategist at Smart Securities. Welcome to another episode of the Talk Stocks with James series. Our topic this evening is second quarter earnings review. What lies ahead for Apple, Amazon, and TSMC? I would also like to apologize for the delay in posting this webinar. It's supposed to happen like 2 weeks ago. I know it's a bit late to talk about this company's earnings now, but still I think it is worthwhile to know about them, as these are the good companies that worth your attention. I'm conducting this Talk with James series every alternate Thursday, 7:30 p.m. The next one would be September 14. And once the webinar concludes, we will also be uploading the replay of this webinar on our YouTube channel as well. So please also subscribe to our YouTube channel, Talk with James, while you are listening to the replay later. Let me begin with some disclaimer first. This presentation is presented to you for education and sharing purpose only and does not constitute to any form of advice. Past performance is not indicative of the future performance. Let's talk about Apple first. Apple is the largest company in the world in terms of market cap. Its market cap is about 2.8 trillion. In comparison, Tesla market cap is about maybe 600 to 700 billion dollars, while Nvidia stands at around 1.3 trillion dollars. A lot of investors have been avoiding Apple as they have been questioning about how can a company grow a lot bigger when it's already worth 2.8 trillion dollars. And they also think that Apple is too popular, is overvalued, over-owned, and is a crowded trade as well. While all of these concerns sounds about right, I would also like to point out that Apple accounts for 51% of the investment portfolio of Warren Buffett. So I also encourage you to see Apple through the lens of the legendary investor Warren Buffett. If Warren Buffett likes Apple so much, should you? Let's talk about Apple's latest earnings. I like to compare revenue from their products with their service revenue. There are a few key takeaways here. Firstly, the product revenue is shrinking, mainly due to lower iPhone sales, which I will share more later. The year-on-year product revenue growth in the latest quarter was negative 4.37%. And secondly, the service revenue has reached a record high of $21 billion, and it has been contributing more and more to the total revenue. Service revenue accounts for 26% of the total revenue in the latest quarter, while product revenue accounts for 74%. And this is exactly what I would like to see. I would like to see that service revenue growing stronger, as the gross profit margin for service revenue is higher than product gross profit margin. The service gross profit margin stands at 70.5%, whereas the product gross profit margin is 35.4%. This is the primary reason why, despite a 1.4% decline in the total revenue in the latest quarter, operating income only experienced a 0.34% decline, because service revenue is a highly profitable business. In any case, both revenue and operating income growth may have already bottomed maybe 3 quarters ago, and hence if there is any price correction in Apple, I think it could be quite shallow. If we look closely at the product revenue, the number does not look so good. The iPhone revenue, which accounts for 48.5% of the total revenue, fell 2.45% year-on-year in the latest quarter. Additionally, MacBook sales, iPad sales declined by 7.34% and 19% respectively. Since iPhone revenue contributed to 48.5% of the total revenue, let's all focus on the smartphone sales first. The global smartphone shipment dropped by 10% in the second quarter this year, implying that the decrease of the iPhone sales is not exclusive to Apple, but rather an industry-wide concern. But if this is an industry problem, maybe we have already seen the worst year-on-year decline 3 quarters ago. Next, we also like to look at the iPhone market share and shipment. iPhone is now the second largest smartphone player with 17% market share. The year-on-year iPhone shipment declined by 13%. It seems worrying, but I think maybe a lot of iPhone owner is waiting for the iPhone 15 launch on 12 September. Overall, I remain relatively unconcerned about the iPhone sales. My reasoning is that if iPhone owners choose not to make a purchase this year, they are likely to make the purchase next year, because Apple has one of the best loyal customers in the world. Apple has a customer retention rate of 90%. Furthermore, should Apple customer delay their iPhone purchases, they would eventually acquire iPhone at a higher price due to the iPhone prices will increase every year. Next, we also like to look at the global computer shipment as well. Even though the latest quarter dropped by 12% year-on-year, the PC shipment itself may also bottom 3 quarters ago. And Apple MacBook sales actually outperformed other players. MacBook shipment increased by 50% in the latest quarter. In comparison, the global shipment declined by 11.5% over the same period, and Apple's market share is now 11% itself. It has been slowly increasing. Overall, I think that Apple earnings result was okay. For those who think it's bad, I think your expectations might be too high. Here I also list down some of the investment thesis for Apple. Firstly, Apple has one of the best ecosystem in the world. It has 2 billion devices in use, 1 billion paid subscribers. Secondly, despite the iPhone sales is coming down, the Apple service revenue is at the record high now. As I mentioned earlier, the service gross profit margin is at 70%, and it has helped pull up the overall profit margin. And thirdly, I think that the Vision Pro sales may surprise all of us. Currently, the analysts expect the Vision Pro will pass a user base of 20 million in 5 years' time. Meaning to say, Vision Pro will outsell MacBook in 5 years' time. I know some investors are quite skeptical about Vision Pro due to the high selling price at $3,499. However, in the past, Apple managed to sell 4.8 million units of the Apple II worldwide, each priced at $6,270 in today's context. So considering that Apple II achieved such significant sales number with such a high price tag 46 years ago, I think we should not underestimate Vision Pro. According to Bloomberg consensus, out of the 52 analysts, 34 recommend buying the stocks, 14 recommend holding it, 4 recommend selling it. Yesterday's closing price was $187.65. The 12 months target price is $202.35, indicating an upside potential of 20%. Indicating an upside potential of 7.8%. Okay, and now let's talk about Amazon. Amazon is my favorite e-commerce company. I think it's better than Alibaba, Pinduoduo, JD.com, Mercado Libre, Shopee in terms of the business model. Amazon is the clear market leader in US e-commerce, holding a market share of 37.8%. While Alibaba is the e-commerce market leader in China, I always have concern about whether Alibaba can maintain its market leadership over the next few years. However, I do not share the same concern about Amazon's market share in the United States. I believe that Amazon has fully established itself as the solid market leader in the US. Having said that, I believe Amazon is the best e-commerce player to invest if you really want some e-commerce exposure. But a lot of investors may not like Amazon, not only because it's one of the worst performance in terms of share prices among all the big caps tech stocks in the past few years. It is also because of its low profit margin, net profit margin at only 5.02%. In comparison, the net profit margin for Apple, Alphabet, Meta platforms are around 24%. So imagine $100, imagine every $100 that Amazon earned, the take-home profit is only $5. It is a really tough business to be in for Amazon. And I believe that if you have a problem with that, I guess Amazon is not your cup of tea. But I also reckon that Amazon purposely lowered down the profit margin in order to grab more market share, in order to establish themselves as the market leader. So I'm totally fine with that. I'm totally fine with Amazon low profit margin. The net profit margin was as high as 10.4% in the fourth quarter 2021 at some point during the COVID period. But I guess Amazon CEO Andy Jassy is not comfortable in making too much money. So he just decided to reinvest everything into new initiative or building more fulfillment center and hence lowering down the profit margin. So I guess Amazon has the ability to make higher profit margin. They just decided not to in a growing market in order to grab more market share. Let me explain Amazon business model. It has it has many businesses, so it's very difficult to digest. It has the first-party e-commerce business, which is called online store business, which accounts for 39% of the total revenue. And nowadays, everyone just think that it is a super low profit margin business, and hence many investors have urged Amazon to let go of the first-party business. But I simply don't reckon that Amazon would exit the first-party business because Amazon ultimately wants to have a wide variety of products available on the platform to ensure that customers maintain the habit of going into Amazon platform every day because they just know that Amazon would have the product they want online. To me, Amazon e-commerce platform aims to achieve three primary objectives: fast delivery, a diverse range of products, and affordability. And the first-party products listing aims to fulfill two of the objectives, which are affordability and a wide variety of the products. So maybe first-party business is not profitable, but Amazon would still want to maintain it. The third-party seller services, on the other hand, is a high-margin business. The take rate generally range between 8% and 15% of the final sale price. And I reckon that what Amazon intend to do here is to take all the profit in the third-party business to build more fulfillment center and subsidize the first-party business, just to ensure that the first-party products are the cheapest compared to other platforms. And the other main source of the revenue includes advertising revenue, AWS revenue, and the Prime subscription revenue itself. Essentially, Amazon aims to emulate the Costco model by charging customer a membership fees. So Amazon come up with this Prime membership subscription itself. For example, in order to step inside of Costco store to buy things, you will need a Costco membership. But Amazon Prime offers so much more than just providing access to the cheaper products listed on Amazon. It also provides you super fast delivery service, as fast as 2-hour delivery. Moreover, Amazon Prime membership grants you the ability to stream movies similar to Netflix and enjoy Prime Music similar to Shopify, among many other benefits itself. The annual subscription fees currently is $139 in the US. However, JP Morgan estimate the value of Amazon Prime to be as high as $1,225 per year, indicating significant room for potential price increases in the future. Currently, about 67% of the US households have Amazon Prime in their house, and Amazon has more than 200 million paying Prime memberships worldwide. So by understanding the business model, you will now also understand that the first-party online stores revenue is not so important. And in fact, it has been contributing less and less to the total revenue, from 53% in fourth quarter 2020 to 39% in second quarter 2023 itself. So you should focus on other promising segments. For example, the contribution of third-party seller business has risen from 21% to 24% over the same period. The Prime membership services increased from 5.6% to 7.4%, and the advertising revenue contribution has gone up from 5.9% to 7.9%. And AWS also increased from 10% to 16.5% in the latest quarter itself. So when you also look at the year-on-year growth in terms of the quarterly earnings, you will now not focus on the slow growth of the first-party business itself. And personally, the first-party online store growth, right, doesn't bother me at all. As long as third-party sellers revenue, Prime membership revenue, advertising revenue, AWS revenue still maintaining double digits growth, I see a bright future ahead for Amazon. And if you like advertising business, you must know that the top three players worldwide are Google, Meta platforms, and Amazon. Amazon market share in the advertising revenue has been increasing over the years from 3.6% in 2019 to around 7.2% in 2022. And it is unsurprising to see that Amazon advertising business is booming because customer qualities in these platforms are totally different. Customers go to Amazon with the primary focus of buying something, but people go to Google or Facebook to either search for something or look for some form of entertainment. So customer conversion rate at Amazon is typically higher. I also want to briefly talk about the cloud computing business, which account for 16.5% of the total revenue. The problem with Amazon AWS is that while it still maintains the market leadership, the market share itself has remained relatively stagnant at just over 30-something% for the past many years. In contrast, when you look at Microsoft Azure or Google Cloud, right, you could clearly see that they have been slowly expanding their market share. Moreover, AWS growth rate has slowed down in the latest quarter, increasing by just only 12% year on year. In comparison, both Microsoft and Google Cloud experience faster growth as always, with the growth rate of 26% and 28% respectively. So this is why some may argue that Microsoft is a better cloud player to gain exposure to the cloud computing industry. However, Microsoft never truly discloses the actual revenue of Azure. And in the past 1 year, you start seeing many analysts argue that Azure maybe is not as profitable as Amazon AWS. This suggests that even though Microsoft has significantly increased the market share in terms of revenue, it might still lag behind in terms of the market share by operating profit. So if you measure market share by revenue, probably you could see that Microsoft is gaining market share. But if you measure market share by operating profit, I would say that maybe Amazon AWS is still the clear market leader. Recently, there is also a leaked court document about during the Microsoft Activision Blizzard hearing that show that Azure revenue is actually lower than many analysts' expectation. Having said that, while I'm concerned about the AWS by Amazon, AWS growth itself, while I'm quite concerned about the AWS growth, I'm also quite skeptical about Microsoft Azure growth as well. In other words, I reckon that Amazon AWS is still okay. If you reckon that it's not okay, you are just being mean. Lastly, I also like to show you the yearly return versus the free cash flow. I noticed that whenever there is a substantial increase in the free cash flow, Amazon share price usually end the year with substantial gain. And just to highlight a few examples, in 2013, the free cash flow increased by 414% year over year, and the share price increases by 58%. In 2015, while the free cash flow year-on-year growth is 241%, the share price returned 117%. In 2023 year to date, the share price has increased by 60%, and the first 2 quarters of the free cash flow this year is only negative $4 billion. So the remaining 2 quarters may post a positive FCF, suggesting that the Amazon may end the year with positive free cash flow. And I would say the free cash flow itself, right, may revert to positive this year onwards. So investors should not be so negative about Amazon. All in all, the worst may be over for Amazon, as we have seen the worst year-on-year decline in Amazon in first quarter 2022 at a negative 58% year-on-year growth. We are seeing a 131% increase in the latest quarter in the operating profit, suggesting the worst is over for Amazon. Even though the much of the operating income improvement may come from cost-cutting measures such as layoff and shutdown of some unprofitable departments. But so some may also argue that this 131% growth is not really organic growth, but I still take it as a win for Amazon. Currently, according to Bloomberg consensus, most analysts has a buy rating for Amazon. Yesterday, closing price was $135. The 12-month target price is $173, indicating an upside potential of 28%. And finally, let's talk about TSMC. TSMC is my favorite semiconductor stock in the semiconductor industry other than NVIDIA. Unfortunately, the share price for TSMC has not been performing well in the past few years, largely due to semiconductor industry being in a down cycle. And in terms of the worldwide semiconductor revenue, we may already see the worst year-on-year decline of 21.6% in April, because the situation slightly improved in June with only a decline of negative 17% year-on-year. But I reckon the recovery itself is still quite slow, and hence investors are not really excited about it. We want to look at the latest earning result. The earnings are within expectation or slightly above their own guidance issued by TSMC. The net revenue came in at 15.68 billion, but is still 13% lower than the same period 1 year ago. The gross margin is 54%. 1 year ago, it was 59%. Operating margin is 42%. 1 year ago, it was 49%. The next quarter earning guidance also show that management expect the revenue to be between 16.7 billion and 17.5 billion. The gross profit margin to be between 51.5% and 53.5%. The operating profit margin to be between 38% and 40%, mostly below analyst expectations. And the operating margin has not dipped below 40% from the past many quarters for quite some time now. The last quarter it dipped below 40% was the second quarter of 2021. So I reckon investor might be mentally unprepared to see the operating margin lower than 40% in the coming quarters, which TSMC has a high probability of having the operating profit below 40%. Let's look at the revenue by platform. The high-performing computing and smartphone accounts for 77% of the total revenue, and HPC and smartphones fell 7% and 21% year-on-year in the latest quarter. So it's quite concerning. One question I ask myself is that why chip maker TSMC, which also produces chips for NVIDIA, has not benefited as much as NVIDIA from the AI boom itself? The answer lies in the fact that NVIDIA only accounts for 6% of the TSMC revenue. NVIDIA contribution to TSMC revenue is still relatively small to make a significant impact. And the overall advanced AI chips only make up a small segment of TSMC overall business at the moment. But TSMC CEO C.C. Wei also say that the revenue contribution from AI chips would rise to about 12% or 13% of the TSMC total revenue within the next 5 years, with a CAGR of 50%. So TSMC will definitely benefit from AI boom, but the AI boom now is not fast enough to save TSMC, at least not within this year. Even though TSMC is the market leader in advanced nodes, there is something about the business model that makes investors stay away from TSMC. Just like Charlie Munger says, the TSMC business model revolves around consistently reinvesting profits into capital expenditure. This is because TSMC's business growth heavily depends on the technological advancement and hence the need for capital reinvestment. For example, if you look at Coca-Cola does not need to constantly spend huge amount of money researching on how to make their beverage taste better. Or McDonald's doesn't need to invest heavily in researching how to improve their burger. But for TSMC, they need to incur a lot of capex every year to make advanced chips. So it's really a tough business to be in. Although the company has generated high profit margins and has been able to pass the cost to customer, TSMC must spend a lot on capex to stay ahead of the competition. Currently, according to Bloomberg consensus, most analysts has a buy rating on TSMC. Yesterday closing price was $94. The 12-month target price is $116, indicating an upside potential of 22%. And here I'd also like to show you an example of an aggressive portfolio that I recently constructed for an investor with a high risk tolerance level. The main purpose of showcasing you this portfolio is to share with you my stock preference within a portfolio. As you can observe, among the stocks I discuss in this webinar, my preferred ranking for the stocks is as follows. Apple take the top spot, followed by Amazon and TSMC. This is why Apple has the higher weight in the portfolio compared to others at 13%. I also like to share a bit on the market timing. In the case of Amazon and TSMC, I don't reckon there is great urgency to get invested in Amazon and TSMC, as they are still 20% or 30% off their all-time high. I don't see they are good catalysts in the near term to push those share prices higher. As for Apple, the prices in the past 1 year were always trading near the all-time high, and the price corrections itself for Apple is relatively mild compared to the other two names, namely Amazon and TSMC. Thus, if you don't have much technology sector exposure, you might want to gain exposure to Apple first. And I shall end my presentation here. And let's now proceed to the Q&A session. If you have anything that you would like to ask, please type in the Q&A box and I will try to answer all of them. Okay, this is a good question. So what do you think about IPO? So I reckon that is a good company. I think it will be listed probably in the mid of September in US NASDAQ. I reckon it's a good company. This is why NVIDIA wanted to acquire ARM, but eventually, unfortunately, it failed. I would say that the IPO price should be super expensive. The PE ratio could be around 120 times. In comparison, you can argue that NVIDIA PE ratio is 250 times. That makes PE ratio at 120 times seems cheap, seems undervalued. But you also need to bear in mind that the revenue growth in the latest quarter, if you were to look at the IPO prospectus itself, is negative 1% year on year. So the revenue growth is probably quite disappointing for a growth stocks of a PE ratio of 120 times. And so unless ARM raises the licensing fee by a lot, I would say that the revenue growth may continue to disappoint in the coming quarters. My preliminary studies tell me that ARM is a good company. It has good brand name, but maybe slower growth in the near term. All in all, I would say that I have not studied enough to say that this is a really good investment for long term. Okay, do you recommend short selling NVIDIA share first and then buying back later? So I would say that the short answer is no. I don't think investors should short sell NVIDIA first and buy back later, because there is a high likelihood that you will get short squeeze. I think the better investment strategy is to wait for a lower price, or another better investment strategy is to probably invest part of your investment at the current price and gradually add position in NVIDIA itself if you really like the AI story. But if you were to ask me, can NVIDIA go down to $400 or $300 first before going up again to maybe $600 or $700? My answer to that is probably yes, it may go down first. But I would say that if you are an aggressive investor, you are an aggressive growth investor with a high risk tolerance level, and if your portfolio doesn't have NVIDIA at all, your performance may lag behind the benchmark. This is why a lot growth investor, they still need to get into NVIDIA exposure itself. I believe recently there's an article saying that a lot of investors still doesn't have NVIDIA and they are rushing in to invest. Yeah, so this is why it kind of like still maintain the share price. Okay, yep, I believe I've answered all the questions. Thank you for coming. I hope you have a great night. Happy voting tomorrow. Happy weekend, and I shall see you soon. Thank you.